Good morning, everybody. Today we're doing our financial reporting update, getting ready for 30 June 2017. Now, this financial reporting update is usually the big one for the year because everybody's starting to think about the preparation of their financial statements for 30 June 2017. So what will we cover today? We'll look at 7 areas. We'll look at the new mandatory accounting standards for 30 June 2017 year ends. Then we'll look at the new mandatory accounting standards for 30 June 2017 half years. In the third section, we'll look at Corporations Act and other regulatory changes. In our fourth area, very important, we look at ASIC focus areas. Our fifth area, the ACNC focus areas if you are a not-for-profit entity. In number 6, very high level, very briefly, what are the latest developments in the accounting world? And then I'm going to end off with a little bit of audit. If that surprises you, there's a very important reason for that. There's a new long-form audit report for listed entities, and that will include key audit matters. So I think we have to discuss that just at a very high level so everybody is aware of that change. So 7 areas in today's webinar, the financial reporting update getting ready for 30 June 2017. Now, as always, this presentation is only for training purposes. It's not technical advice. If you need technical advice, please contact any of our partners at BDO. So our first section, new mandatory accounting standards for 30 June 2017 year ends. Now the good news, we don't have any major new accounting standard that is mandatory for 30 June. So the new AASB 9, 15, 16 and for not-for-profits AASB 1058 is only applicable in a number of years' time. We still have to start to plan for them and think about their implementation, but if you think about mandatory accounting standards for 30 June, no, they're not there, nothing major. So if you look at the mandatory standards, there are 2 Australian accounting standards, AASB 14, regulatory deferral accounts, and there's AASB 1056, superannuation entities. The regulatory deferral accounts is for years beginning on or after 1 January 2016 and for superannuation entities beginning on or after 1 July 2016. So absolutely both of them applicable for 30 June 2017 year ends. However, AASB 14 is only, it's not expected to have widespread application in Australia, because it only applies to first-time adopters of IFRSs that conduct rate-regulated activities and recognise associated assets and liabilities in accordance with their current national GAAP. An example of that would be in Canada. So we don't expect to see much of AASB 14 within Australia, and therefore I'm not spending much time on that. AASB 1058 is for a very specific industry, and that is superannuation entities, and again not talking about that today. The other Australian accounting standards are all amending Australian accounting standards, which means they've issued amendments to existing standards. And at the moment we've got 9 of them that would impact 30 June 2017 year ends. If you look at the list, you'll see the last 2 on the right-hand side at the bottom are only applicable after 1 July 2016, so absolutely 30 June 2017, but both of them relate to not-for-profit public sector entities. So AASB 2015 number 6 and 7 will not be discussing today because again it's focused on public sector entities. Therefore, if you are a for-profit entity or a not-for-profit private sector entity, you basically have 7 amending standards that you should consider how they impact 30 June 2017, and they are listed there. Let's look at those 7 briefly. So first of all, at AASB 2014-3, which talks about accounting for the acquisition of joint operations. So what is amended, or what's been amended in AASB 11 joint arrangements? AASB 11 now prescribes accounting for the acquisition of a joint operation that constitutes a business. And they say that the acquisition approach outlined in AASB 3 should be followed, which means that assets and liabilities recognized would be recognized at your share of the fair values, and you would also have related deferred tax assets and liabilities. Acquisition-related costs are expensed, and goodwill would be recognized as the excess of the consideration over the fair value of the identifiable net assets required. I think the critical thing here is in that first bullet point that assets and liabilities are recognized at your share of the fair values. So only your share. And then previously held interests are not remeasured. Also, it's important to note that this new principle or the above principles apply on the formation of a joint operation if on formation an existing business is contributed to this joint operation. So this amendment does not apply if assets and liabilities are contributed to the joint operation. So it's only when a business is contributed. And this is aligned with what we do with normal business combinations. If it's a business combination and it's a business and it meets the definition of a business, or the acquiree meets the definition of the business, we fair value assets and liabilities at the date of that business combination. If it's assets assets and liabilities, if it's just a normal asset acquisition, we don't fair value. So this is a similar concept to what we already have in AASB 3 for normal business combinations. So important, if you do acquisitions of joint operations, if you apply AASB 11 joint arrangements, you should consider this amendment. The other one is the clarification of acceptable methods of depreciation and amortisation. So changes were made to AASB 116, property, plant and equipment, and AASB 138, intangible assets. And first of all, in the first bullet point, revenue-based depreciation method, a revenue-based depreciation method is not permitted for items of property, plant and equipment at all. And then the second bullet point addresses intangible assets, AASB 138, and it says revenue-based amortisation method would usually not be permitted for intangible assets. In limited circumstances, you could use it. And then there are two examples. So that would be the intangible asset is a measure of revenue. An example would be you've got a right to operate a toll road, a road or roll until a certain amount of revenue has been generated, or revenue and the consumption of the economic benefit are highly correlated. Now an example is a concession to extract from a gold mine until a certain number of revenue has been generated. So I think important to note that if you've got the revenue-based amortization for intangible assets, it's a very high hurdle to pass, and you have to think about it very carefully, and not allowed at all for depreciation of property, plant and equipment. The third one, AASB 2014 number 6, is the bearer plant amendment, and it's amendment to AASB 141. Now, first of all, what is a bearer plant? A bearer plant is a living plant that is used in the production process of agricultural produce. It is expected to bear produce for more than one period and has a remote likelihood of being sold, except for incidental scrap sales. Now, bearer plants have been excluded from the scope of AASB 141 for periods beginning on or after 1 January 2016. And important to note that earlier application is permitted. So if it's excluded from AASB 141, where would we account for it? And we would account for bearer plants in accordance with AASB 116, property, plant and equipment. and that says you can either account for the bearer of plant using the cost model or the revaluation model. Now this is a big change because previously when bearer plants were included in AASB 141, you would account for it normally at fair value, and changes in fair value would have gone through profit and loss. Now you can select the cost model or the revaluation model, and if you use the revaluation model, increases would go to other comprehensive income as a revaluation reserve. The next one is AASB 2014 number 9, the equity method in separate financial statements. Now it's interesting, whenever we speak to clients, whenever we speak to partner staff internally at BDO, it's very important to distinguish between your consolidated financial statements and the separate parent entity financial statements. So separate financial statements or parent entity financial statements, like we used to call it in the old days, have certain rules, certain requirements, and then a separate deal on how do we do consolidated financial statements. So often we need to remind people, remember to think about the separate financial statements and then think about consolidated financial statements. So what is this amendment about? Or why do we have this amendment? So it's important that it was to facilitate convergence in some countries that apply IFRSs, and some jurisdictions require an entity to apply equity accounting for subsidiaries, joint ventures and associates in their separate financial statements. So what amendments were made to AASB 127 in Australia to align or to get to convergence? And they've added an option to allow entities to account for investments, to account for subsidiaries, joint ventures and associates using the equity method in separate financial statements. So previously you would only have the option to account for it at cost or in terms of AASB 139, which would have been fair value. It would depend on the category. However, whether it's held for trading or available for sale, and often investments in subsidiaries, joint ventures, associates would actually be available for sale. So there's now a third option added, that in the separate financial statements you could use the equity method for investments in subsidiaries, joint ventures and associates. Not to be confused with the accounting treatment that we have in consolidated financial statements. There all the normal rules apply, that in consolidated financial statement, if you have control, you consolidate, and if you have significant influence, it would be equity accounting, and if you've got a joint arrangement, joint control, you would apply AASB 11. Then AASB 2015 number 1 are some annual improvements, and as you know, the annual improvements are issued once a year. It's minor or small amendments to a number of standards, usually more along the line of clarifications. So AASB 2015 number 1 is similar. It makes an amendment to AASB 7 financial instruments around the disclosures and specifically servicing contracts. And it clarifies that an entity has continuing involvement in a transferred financial asset where servicing of a transferred asset includes a service fee that is dependent on the amount or timing of cash flows collected from that transferred asset. So it's really clarifying that. Then also another amendment to AASB 7, financial instrument disclosures, and it's around the applicability of the offsetting amendments in condensed interim financial statements. So the amendments offsetting financial assets and financial liabilities do not need to be applied to interim periods. So if you're doing 30 June 2017 half years, you would take note of this. In some cases, they might be required to conform with AASB 134 if their omission would make the interim financial statements misleading. Also another change, and this one to AASB 119 employee benefits, and it's around the discount rate used in the determination of employee benefits. And again, a clarification that if you use high quality corporate bonds or if you use national government bonds, that whatever you use, you have to determine the discount rate, and it must be, if you use high quality corporate bonds or national government bonds to determine your discount rate, it must be denominated in the same currency as the employee benefits. So there's a direct link. So again, a clarification. AASB 2015 number 2 is the disclosure initiative, which the AASB says we would allow you to remove certain things, to reorder certain items in your disclosure of financial statements. We would like you to regroup, re-emphasize. So a number of things that we thought entities should look at. This is a great opportunity to make sure that financial statements are more useful, more user-friendly, and providing the right message. So they've actually given us, the AASB has given us the opportunity to remove unnecessary accounting policies. So if you have an accounting policy for intangible assets but you don't have any intangible assets, why do you have it? It's just adding a lot of volume to your financial statements and potentially confusing users. They also say they would like us to tailor boilerplate wording on accounting policies to suit client circumstances. So don't just take model accounts and put all the fancy word in the financial statements. Tailor it to your organization. Make sure that's been adopted within your organization. So they say remove redundant disclosures, remove disclosures that are duplicated in multiple places, so cross-reference instead. You could also reorder. So a number of people have been saying, you know, we usually start note 1, all our accounting policies, then note 2, we've got significant estimates and judgments, and then we've got all the financial statements, and they follow the order of presentation in your statement of financial position, etc. And this is a recommendation to potentially reorder accounting policies. Maybe move accounting policies to the relevant note. Instead of having all the accounting policies in note 1, maybe we should have a property, plant and equipment note with the accounting policy and then the disclosures, an intangible assets note with an accounting policy and then the disclosure. But you can go further. You can decide how you want to group items together. And you can decide in what order you want to provide it. It doesn't have to follow the order of presentation of the statement of financial position. I think it would be great to move accounting estimates and judgments, the traditional disclosure in note 2 to the relevant note. It would be so easy to say this is the accounting policy, this is the disclosure, this is our significant accounting estimates and judgments. And then also you can reorder, so you can move key information to the beginning of financial statements. The third one that we've got there is regroup. So group similar information within the same note, group related notes together. Consider introducing sections to the financial statements. We could have a section around assets, section around financial instruments, a section around revenue, depending on what would be important and what you would like at the start of your financial statements, what would enhance user understanding of your financial statements. And then the last one is re-emphasize. So highlight key changes in the financial statements, emphasize key information, and consider the use of non-technical language for certain disclosures. So more around normal English. And that is very hard. But this is our opportunity to try and make financial statements a real communication tool to the users, to provide useful, relevant information to our users. The next one is AASB 2015 number 5, and that is investment entities applying the consolidation exemption. So there were amendments made to AASB 10, to clarify how intermediate parent entities should apply the scope exemption from preparing consolidated financial statements where the ultimate parent is an investment entity. So again, this is a clarification. Questions arose after that exemption was first introduced. So the exemption to intermediate parent entities from preparing consolidated financial statements are provided if certain criteria are met. First of all, the ultimate parent entity prepares consolidated financial statements that comply with IFRS and is available for public use. And then also the exception applies even if the ultimate parent is an investment entity and does not prepare consolidated financial statements in accordance with AASB 10. Alright, so that is our criteria. So you can see, if you look at the new mandatory accounting standards for 30 June 2017 full years, not many changes, really aimed at clarifications of certain specific areas, and none of them could be applicable to your business, or some of them could, and it would be going through that list and considering to what extent you should apply them. The other one is if you are preparing 30 June half years, there is one standard to consider, and that is AASB 2016 number 1, the recognition of deferred assets, deferred tax assets for unrealized losses. And that 4 main amendments were made to AASB 112. So again, if you've got unrealized losses, you're doing half-year accounts, important to look at these amendments. So 4 of them. Your deferred tax asset, DTA, deferred tax asset, must be recognized for deductible temporary differences between the fair value and the tax base of a fixed rate debt instrument that is not impaired. And remember, all the other recognition criteria must be met. The second one, when determining if sufficient taxable profits exist to be able to use the deductible temporary differences, we have to compare our deductible temporary difference to taxable profits of the same type, for example, revenue or capital. The third one is to avoid double dipping when comparing deductible temporary differences against the amount of future taxable profits. You have to exclude tax deductions resulting from the reversal of those deductible temporary differences. And then the last one is your estimate of future taxable profits can include a recovery of certain assets above their carrying amount. However, sufficient evidence must exist that that would be probable. So again, it's a very specific and a narrow application, recognition of deferred tax assets for unrealized losses in 30 June 2017 half years, and we'll look at it again for 31 December 2017 full years. In the next section, which is section 3, I would like to look at Corporations Act and other regulatory changes. Now, first of all, as you know, ASIC has been going through a process of replacing expired class orders with corporations' legislative instruments. And the latest one was in March this year. Class Order 9898 has been replaced by ASIC Corporations, and in brackets Foreign Controlled Company Reports Instrument 2017-204. And this class order allows a small foreign controlled entities whose results are included in the consolidated financial statements lodged with ASIC to obtain relief from lodging financial statements with ASIC, and also to obtain relief from the requirements of Section 601 CK of the Corporations Act. So this is really rolling that forward, and I know Class Order 9898, that is a class order that's widely used within our client base. So remember to look at the right legislative instrument. The other one which is widely used is ASIC current or previously Class Order 98-1418. It's been replaced with ASIC Corporations Wholly Owned Companies Instrument 2016-785. These new names are so lengthy, it's unreal. I'm so used to the old short numbers. And this one is where wholly owned entities that are party to a deed of cross guarantee at year end are relieved from the requirement to prepare and have audited and lodged their annual financial statements with ASICs. And there's quite a number of conditions that have to be met to get this relief. I suppose the main one would be the deed of cross guarantee that they need in place. So the commencement date of this one was 29 December 2016, so definitely applies for financial years ending on or after 1 January 2017. Again, to make sure that you are using the correct class order. I thought I'll just give you a list of some of the potentially relevant class orders that have over the last 1 or 2 years been replaced by a legislative instrument to make sure that you use the right one in your financial statements. The third one on that list is interesting, and that is ASIC corporations rounding in financial and directors reports. A number of our clients use that. Please make sure you've got the correct reference. And there's another list, so quite a number of information that you should consider. I suppose the other one that's interesting is the second last one on this slide, and it's audit relief, so the old class order 98-1417. So on these two slides, these are the legislative instruments just to confirm that they've replaced the previous class orders. Make sure you apply with the correct instrument. The other thing that I would like to look at would be the tax laws amendments, and this is combating multinational tax avoidance, and this bill was issued in 2015. And it's all around general purpose financial statements for multinationals. So what is this bill and what is it for? So this bill amended the Taxation Administration Act 1953 on the 3rd of December 2015. And it requires significant global entities to lodge general purpose financial statements with the Commissioner of Taxation if the Australian subsidiary does not lodge general purpose financial statements with ASIC. So the purpose of the bill is to find out if multinationals are paying enough tax in Australia. So the question would be, what is a significant global entity? Now, a global parent entity with an annual global income of more than 1 billion Australian dollars would be a significant global entity, or a member of a group of entities consolidated for accounting purposes, and one of the other group members in this global parent entity has an annual global income of more than 1 million Australian dollars. So they're really looking at those big global entities, making sure that they lodge general purpose financial statements to the Commissioner with Taxation. I think it's important to note that the Commissioner of Taxation would provide that to ASIC, and therefore it would become publicly available. So when will these changes be effective? For income years commencing on or after 1 July 2016. So we're looking at 30 June 2017 year ends. So it would be interesting when we start to see these being published or being made available to the Commissioner of Taxation, and then also the expectation that it would be passed on to ASIC. So which entities will be impacted? So if entities currently lodge general purpose financial statements with ASIC, no impact. If entities currently lodge special purpose financial statements with ASIC, they would potentially have to upgrade to general purpose financial statements Tier 1 or Tier 2 for lodgement to the ATO. If the entity does not lodge anything with ASIC at the moment, not even special purpose, it could be that they are large grandfathered private companies, or it could be that it's small foreign controlled PTY companies that's applying the old class order 9898. Doesn't matter. For both of them, there is that issue that they'll have to upgrade to general purpose financial statements, Tier 1 or Tier 2, to be lodged with the ATO. So you can see more and more from different areas there's pressure on special purpose financial statements. We know the AASB conducted some research in this area, and it's ongoing research. I know regulators are constantly talking about it, and this is just another example where more and more there's pressure on entities to prepare general purpose financial statements. So what questions would remain outstanding? The first one is whether these financial statements have to be audited. The other one is whether reduced disclosures, so whether Tier 2 RDR would be permitted. You know, on the previous slide I've made the assumption we upgraded general purpose financial statements Tier 1 or Tier 2, but that's not really clear. And the third one is whether the ultimate Australian group need to be lodged, or whether the overseas group would suffice. So if we know the overseas group prepare their financial statements, do we just lodge that with the ATO? Or, you know, do we look at the ultimate Australian group? So these questions, we're still waiting for them to be resolved, but those are interesting questions. The other one that's really interesting, looking at recent budget announcements, is the expected changes to company tax rates, and that tax cuts are expected to pass through Parliament, and therefore it would be substantively enacted. And it looks as if a corporate tax rate of 27.5% will apply for companies carrying on a business with a turnover not exceeding 10 million. It would already apply for income tax years ending on 30 June 2017. If it's a turnover not exceeding 25 million, it would be 2018, and a turnover not exceeding 50 million by 2019. So this raises a question from an accounting perspective: how do we account for it? So what changes will need to be made in financial statements? So a reduction in corporate tax rates would impact current tax calculations only in the year it becomes effective. However, for deferred tax, once these changes have become substantively enacted, therefore in Australia through both houses of Parliament, measurement would be based, or your deferred tax asset or liability, your measurement would be based on the rates expected to apply in the period the asset is realised or the liability settled. So yes, for current tax, we wait for the year in which it becomes effective. However, for deferred tax purposes, once it's substantively enacted, we already change our deferred tax calculations. So what if substantive enactment occurs between the 1st of July and when your financial statements are authorised for issues? Then it would be a non-adjusting post-balance sheet date disclosure under AASB 110. The next area that I would like to look at, and this is really important, would be the ASIC focus areas for 30 June 2017. Now, ASIC has not formally released their updated focus areas for 30 June 2017, but I've done an analysis of their focus areas up to those published 31 December 2016. They haven't changed over the last 2, 3, 4 years, and therefore this presentation is really based on that, and we actually expect very similar focus areas for 30 June 2017. Now, the ASIC focus areas can really be grouped into 4 main focus areas. The first one being accounting estimates, the second one accounting policy choices, the third one material disclosures, and the fourth one the role of directors. So these are the 4 main focus areas and have been for a number of years. So if you look at accounting estimates, within that they really focus on impairment testing, and they've issued guidance to directors of companies on the questions that they should be asking themselves, the board, management, and they should be discussing. So there's actually been a lot of talk around, what are the responsibilities of directors around impairment testing. And I would advise that you look at that if you're a director of a company. The other one is around asset values and determining fair values. So if you've got an asset that's recorded at fair value, how do you do that? What disclosures do you do? Very important. So around accounting estimates, we know there's a number of accounting estimates, and it's important to to deal with accounting estimates very carefully. It's a lot harder than just looking at historical cost, but impairment testing and fair values, two main focus areas. The second big group would be accounting policy choices. The first one there is off-balance sheet arrangements. A huge emphasis, and it's been for a number of years, around structured entities that are off-balance sheet, so research entities or entities incurring a lot of expenses on behalf of the entity that's not being consolidated. Consider the requirements of the new AASB 10, whether you've got control of that entity, whether or not you've got a shareholding or not. So it's more around the definition of control in AASB 10. So important that we don't have off-balance sheet arrangements. If it's controlled, it's consolidated. The second one there is revenue recognition, and this has been a big emphasis. Worldwide, there's been this emphasis by regulators, by users, by analysts, by standard setters, that revenue is an important number, it's a sensitive number, it's a number that users and analysts look at, and therefore we have to be very clear on our revenue recognition policies and that it's in compliance with the current accounting standards. And as you know, there's a new standard coming in 2 years' time around revenue recognition that's been developed as a result of this big pressure around revenue recognition and getting the number right. So huge emphasis on revenue recognition. Also expense deferral. So instead of expensing an item, to actually capitalize it and expense it in future periods. You know, are you sure that you currently meet the definition of an asset, that there are future economic benefits that's under your control? So be very clear that we don't create assets, recognize assets where we should instead have expensed it. And then the last one is around tax accounting. Emphasis on tax accounting, application of AASB 112. Not only current tax but deferred tax. The third group there is material disclosures, and within that two main areas, and that is that ASIC says there's a number of entities who we know make estimates, make significant estimates and make judgments around their accounting policies and application of accounting policies, and we would encourage them to disclose that and to disclose sensitivities to users. So that's a big one. So that's our traditional note 2. And I think that's really important given the new long-form audit report, because I can think that there would be a big link between the new long-form audit report, key audit matters, and note 2, the estimates and accounting policy judgments. The other one that I would like to focus on for material disclosures, and this is really important, is the impact of new accounting standards. So as you know, the new AASB 9 and AASB 15 are applicable for years beginning on or after 1 January 2018. This is for for-profit entities, and leases a year later. However, all these standards would be applicable retrospectively. So if you've got a 30 June year end, it will be included in 30 June 2019. That will be your current year. Your comparative year will be 30 June 2018. And the beginning of your comparative year will actually be 1 July 2017, which is just 2 months away. Therefore, ASIC is saying, if you expect to be impacted by these new accounting standards, you have to come up with a disclosure to what extent you will be impacted, how you've been impacted, and what you've done in order to assess it. And it would not be good enough to just say we haven't done an assessment yet. And then the last area is the role of directors, and I've prepared a slide on that, so I'll come back to that. So impairment testing, as I said earlier, ASIC has released an information sheet number 203, which is specifically directed at directors, and it includes when do we do impairment testing, what is the process for assessing impairment, what are some of the common issues they have found with impairment calculations, and then also questions that directors may ask of external auditors. So that's a useful document for organizations, for directors to look at. If we look at material disclosures, as I said, you know, it's definitely a focus on assumptions supporting accounting estimates. Have we disclosed those assumptions? what significant accounting policy choices have we made, but also the impact of new reporting requirements. And I think it's important to note that ASIC specifically said that we don't pursue immaterial disclosures that may add unnecessary clutter to financial reports. So in my mind, that supports the disclosure initiative which we've discussed earlier as issued by the AASB. So ASIC is saying focus on material disclosures. And we won't have an issue if certain immaterial disclosures are removed because it's just adding unnecessary information. Now, the one that I really want to focus is on the role of directors. And I've highlighted some words here, and that is that even though directors do not need to be accounting experts, they should seek explanation and advice supporting the accounting treatments chosen by the company, and then very importantly, where appropriate, challenge the accounting estimates and accounting treatments applied in the financial report. Yes, we're looking for explanations and advice, but we also have to challenge those. Emphasis on the challenge. Directors should particularly seek advice where a treatment does not reflect their understanding of an agreement substance. So we get the explanation, we get the advice, however, it just doesn't make sense to your understanding of the substance of the agreement, challenge that accounting treatment. Again, further information, there's 2 ASIC information sheets that's recently been issued, specifically directed at directors, and it's talking about directors and financial reporting and also around impairment of financial assets. If you're a not-for-profit entity, we've not forgotten about you. We're looking at the ACNC focus areas. Now this report issued only in March this year. So in March this year, the ACNC issued a report that is looking at an analysis of the data provided by charities in their 2015 annual information statements. Now, they have a 3-tiered approach where they look at potential misstatements. And I just wanted, the level 1 checks are looking at identifying material errors. The level 2 checks, they look at comparing the financial information. And level 3 checks is where they look at detailed annual financial report reviews. Now, the results on this page are coming from that level 3 check, the detailed annual financial report review. Now, first of all, they've said that not all the financial statements outlined in AASB 101 have been included within the annual financial report. So, as you know, if you lodge financial statements with the ACNC, you have to comply with AASB 101. Therefore, you have to include a statement of financial position, statement of comprehensive income, statement of changes in equity, statement of cash flows. If you've had a change in accounting policy or a prior period error, you need a third balance sheet and you need notes. And they found that often that's not happening. Also, the second bullet point around the accounting policy note, often there's no reference to the ACNC Act and importantly, or the mandatory accounting standards. So a number of these financial statements of not-for-profit entities and charities still refer to it's being prepared in compliance with the Corporations Act. It's actually been prepared in accordance with the ACNC Act and lodged with the ACNC Act, and that should be reflected in the accounting policy note. The one around the mandatory accounting standards are around a number of entities who prepare special purpose financial statements have not indicated whether they've complied with the recognition and measurement of all accounting standards, whether they've complied with them or not, or if they've not complied with certain ones, explain that. So really it's confusing information. Now that feedback is very interesting because it's similar to the results that the AASB found when they looked at special purpose financial statements lodged with ASIC, that a number of entities are just not making it clear whether they're complying with the recognition and measurement of all Australian accounting standards. Now at BDO we've got a very firm view that although you only have to comply with the disclosure, the full recognition, measurement and disclosure of a small number of standards. If you do special purpose financial statements, you should comply with the recognition and measurement of all Australian accounting standards. Also, there was no disclosure whether the entity is a for-profit or a not-for-profit entity. We would assume a not-for-profit if they lodged with the ACNC. And then also they thought there were inadequate disclosures around significant judgments and estimates. Again, that's aligned with an ASIC focus area for for-profit entities. The bullet point 3 is around audit or review reports. Now, as you know, there are 3 different tiers of not-for-profits and charities, and for certain ones only a review is required, for certain ones an audit is required. So a number of those where an audit or a review is reported, there were no audit or review report attached at all, or the audit or review report has been incomplete or unsigned. The 4th one important, the responsible person declaration. So quite often there was no responsible person declaration for this entity, which is similar to the director's declaration we have in a for-profit context. Even if there was a responsible person declaration, there was maybe an omission of solvency declarations, and again no reference to the requirements of the ACNC Act. So in our audit report as well, or our review report, it should refer to the ACNC Act. And then related party transactions, they thought that a number of entities have not complied with AASB 1 to 4, which says that you have to disclose transactions with related parties and whether they were at arm's length, and quite unhappy about a general non-compliance with AASB 1 to 4. Now, if we look at the latest developments in the accounting world, and I just want to keep an eye on the time. Now I've got time left. Latest developments in the accounting world. So for for-profit entities, the triple threat accounting standards, AASB 15, 9 and 16. As you know, we've done a number of webinars on them, and we will continue to do webinars on these standards. If my memory is correct, next month we're looking at AASB 15 and an overview of AASB 15. However, if you missed our overview of AASB 16, which was presented in January this year, you can go on our website and watch the recording. And over the last 2 months, we've looked at AASB 9. For not-for-profit entities, they don't have a triple threat of new accounting standards, but they actually have 4 new accounting standards. Because in certain instances AASB 15 would apply to revenue recognition, and in other instances AASB 1058, income of not-for-profit entities. The leases standard and the interaction between that leases standard and AASB 1058 would be interesting, especially in relation to peppercorn leases. Again, I've recorded a webinar on not-for-profit entities, AASB 1058 in February this year, if you want to look at that recording, and there will be future webinars on those. The last item I want to look at today is the new long-form audit report. Now, first of all, there is a new audit report that your auditors will be using for 30 June 2017, and those audit reports will be for all entities, and they would basically the main changes, it would change the order of the audit report. So the audit report would now start with the opinion, then if it's a modified opinion, the basis for the modification, and then later on, you know, the responsibilities of management, responsibility of the auditor. So for all entities, the order of the audit report has changed. However, the big change is for listed entities, and at the moment it's only listed entities. And that is that for listed entities, included in this new audit report is the disclosure of key audit matters. So at the moment it's only for listed entities. We don't know whether in future it would be extended to disclosing entities or other entities. So what is a key audit matter? So key audit matters are those matters that, in the auditor's judgment, so not management or directors or the board's judgment, those key audit matters are those matters that, in the auditor's judgment, were of most significance in the audit of the current period financial statements. And they actually expect these key audit matters to change from year to year, and it will only reflect the issues or the key audit matters in the current year every year. That I wanted to be boilerplate, by the way. So how would an auditor identify key audit matters? I suspect it would be, first of all, matters communicated to those charged with governance. That would be the starting point according to the auditing standard. Then you would also consider which of those matters communicated to those charged with governance required significant auditor attention in performing the audit, and what are the matters of most significant. Significance. If 20 items are communicated to those charged with governance, I don't think we expect 20 key audit matters in the audit report. But the matters of most significant for the current year. Now, what does the auditor have to disclose in the audit report around these key audit matters? So first of all, the auditor has to give a description. So what was the key audit matter? A bit of a description. Secondly, why was this a key audit matter? And then thirdly, how did the auditor address the key audit matter? So this is a lot of additional information. There's been a lot of pressure on auditors to provide more useful information in their audit report to the users of financial statements. And there's been a big international move, and it's here. So if you're a listed entity, start to speak to your auditor about expected key audit matters. So if we do a bit of a recap of the session, we've looked at the new mandatory accounting standards for full years. It was for most entities, there's 7. It's more clarifications, minor amendments, but make sure or consider whether that impacts you. For half years, it was only around a recognition of deferred tax assets for unrealized losses in interim accounts. We looked at the Corporations Act amendments, which were around the ASIC regulatory or legislative instruments replacing the old class orders. Also the new global entities, and that they have to lodge, if they're significant global entities, general purpose financial statements with the ATO. And we also talked about the expected change to the tax rate in Australia. Then we looked at the ASIC focus areas. We looked at the ACNC focus areas. We just touched on the latest developments in the accounting world, the new accounting standards, if you're a for-profit, the triple threat, and that you should start to do an assessment how they would impact your organization going forward, and that should be disclosed as outlined in the ASIC focus areas. And then if you're a not-for-profit, there's actually 4 standards. Peppercorn leases, absolutely look at that, and look at the new AASB 1058. And we ended off with the new long-form audit report. So that's really what we've discussed today. If you are interested in newsletters to stay up to date, short videos, webinars, please go to our BDO IFRS page. You can always email me. Please follow me on LinkedIn, and we'll keep you up to date with new developments. I would like to thank you for attending this webinar. I hope it's been useful in you starting to think about your 30 June financial statements. If you've got any questions, please feel free to contact me. I'll also stay online now. So thank you very much. Take care, and we'll speak soon. Remember, next month AASB 15.